what's going on in the markets as far as unusual option activity, because that's what I make my living on, trading unusual option activity. Today, a little tutorial as well. So let's get into it, shall we? Thank you for joining me, by the way. Our presentation starts out with, this is the 4th of September, 2020. I am Jon Najarian. This is 3 at 3. Our disclaimer is, as always, investments involve risk. This is for educational and informational purposes only. Full stop. Intellectual property, yes. A lot of what you're going to see here is copyrighted. It is trademarked. It is registered marked. It is patented. So please, before you use it, just ask permission. We'd be happy to grant you that permission, but we'd prefer that you asked us first rather than having our lawyers say, hey, this is popping up over here. Did you guys okay this? So please just ask. That's all. Thank you. So, volatility skew. Let me give you a little definition first that you see on your screen, and I am going to read it word for word because I wrote it. Volatility skew, difference between implied volatility between the out-of-the-money calls and the out-of-the-money puts. Okay, so we both understand. Let's say we're talking about a stock that's $55. An out-of-the-money call would be anything higher than $55, say $60, for instance. That would be an out-of-the-money call. Now, an out-of-the-money put would be anything out of the money to the downside. So in this case, if the stock's trading at double nickel, 55, a 50 put would be an out-of-the-money put. So the difference in implied volatility between that call to the upside and out of the money call and this put to the downside, that is a volatility skew. Option traders generally can get an idea of whether trader sentiment is bullish or bearish towards a stock, ETF, future, etc. by looking at call put volatility skew. Next slide. It is normal to see implied volatility in puts higher than calls. Why would that be? Well, there are natural put buyers. They are people who own stock and they are seeking to hedge or to get protection. This would be very similar, and the example we use all the time is car insurance. People understand that if they have an asset and they want to insure that asset against damage, of course you can't prevent all damage. So what if a tree falls on it? What if you get hit by somebody and so forth? Well, auto insurance is very similar to puts because there's a premium, there's a deductible, and so forth. And literally, if a tree fell on my Mercedes sitting outside and crushed it, making it undrivable and perhaps a total wreck, my insurance company, USAA, would cut me a check, give me a check. Now, the same thing's true with puts, except they don't cut you a check. What they do is the put is, for instance, I have a put at Apple, let's say, and I want to protect Apple. And let's say the stock's trading at $115 a share. If I buy a put at the 115 strike, I have zero deductible insurance. I could put that stock to somebody right where it is right now, which I probably would elect not to do. On the other hand, if the stock fell to $100 a share, that put is now $15 in the money. And so, rather than experience that horrible loss against 10,000 shares of Apple, I could instead say, yours, I own a put. I'm giving you the option. I'm not giving you the option. I'm sorry. I bought the put, so I have rights. You have obligations, the person that sold me the put. Your obligation is to buy the stock at the strike price, in this example, 115, no matter where the stock goes to the downside. So, for the past 7 days, we've seen nearly unprecedented demand for upside calls, and that caused the normal skew between the call pricing and the put pricing to shrink to almost zero. Out of the money call premiums were very high. And some of that was because people said there was a whale out there that was buying all of the upside calls. Now, that could be true. Could also be true that that whale bought those calls a while ago, before those calls went in the money, and instead it is the people that delivered that coverage for the market to that whale that are scrambling to buy the protection? We don't know. All we know is that the calls were skewed much higher than normal for the last several days leading up to Wednesday this week. That is what we're watching. So normally you see something like this, implied volatility at the money, that's ATM in the middle, at the money, and then you see out of the money puts, out of the money calls. That would be also called a volatility smile when we see that. Now, according to my friends at the Financial Times, Gillian Tett and all of those smart people over there, somebody had been buying an awful lot of calls. Single stock call option volume had been rising rapidly. And they detailed this by showing us the calls. And you can see the calls here as a sort of magenta, I guess, looking line right there. And then look at the puts. The puts are not being bought in nearly the same number as the calls. And so the people over at the Financial Times that were showing us this, and this is notional volume in billions of dollars traded over a 10-day rolling average, the people over at the Financial Times were saying this was SoftBank. SoftBank was driving that call activity by investing a lot of money in out-of-the-money calls and doing it repeatedly over the last several months. If they have made a fortune. But it could be also that they put that position on, as I say, months ago, and as that position moved towards the money, in other words, from out of the money to ATM at the money, or even in the money, ITM, the people that provided that exposure were now being forced to buy aggressively. Now, that's not a good position to be in, but that might be one of the explanations for what we saw playing out over the past two sessions. If you want to learn more about trading, stock, options, futures, cryptocurrencies, you can do that at marketrebellion.com. If what I just described sounds interesting and you'd like to learn more about that, go to marketrebellion.com/get started. And you can do just that. Learn more about what I am talking about, because this, my friends, was a great tell, and it provided a tremendous opportunity for traders, in particular yesterday and today. And I'll get to that in 1 second. Let me get to this first. Pfizer, one of many firms that's working on treatments as well as vaccines for COVID. We noticed bullish call buying at the 40 strike in October. But notice it's not regular October expiration because there's an 02 in front of that October. The reason for that is that the 2nd of October, a month from today, literally, is an expiration the first week in October where we see unusual call activity at the 40 strike. So they're paying $27 because every option is for 100 shares of stock. They're paying $27 to $33 each for over 7,000 of these calls. So an upside call with the stock at 36. Now, a lot of you know that I'm probably buying a lower strike than that because that's how I like to roll. I like to be closer to the money when I'm buying the calls that I'm buying rather than $4 out of the money, even though that's a nice cheap shot. I'd rather buy something like the 36 or 37 strike and sell the higher strike. Not telling you what to do. I'm telling you what I do. There's a graph of Pfizer today. You see the 1-year graph of Pfizer, and you see it rolling down to 36.29. Do we go right back up to 40? Place that we were at in January of this year? Well, if they have a COVID treatment, you can bet that that's what people are betting on. Today's most active options. Look at that volume again. As you see, 4th of September, 3.8 million calls and puts, because that's contracts, which is both sides, trading in Apple. Tesla, 1.45 million. Bank America, 470,000. Microsoft, 446,000. NEO, 442,000 contracts. Look at the daily volume column on the far right side there. That's telling you the percentage of normal volume. as you see, because of the splits, of course, in Apple and Tesla, that's explained by that 363% jump in volume. Same thing in Tesla, a big jump in volume. But they didn't split Bank America. They haven't split Microsoft or Neo or AMD or Facebook or Nvidia or Amazon or Intel or Zoom. But as you see, many of those trading 150 to 200% of normal volumes. That, my friends, is worth noting. Now, for the rest of the story, as a fellow Chicagoan once said, every single day for, I think, 55 years on the radio, that would be Paul Harvey. Tesla. So, we saw this during the halftime report, and I sent this to the folks at CNBC. Tesla, 9/4, that's today's date, as you see on the far left, and then you see expirations, strike prices. The 400s had traded 46,000 calls versus an open interest of just 5,500. That, my friends, is a ton, because the open interest on a stock split, that also changes along with the volume and the price of the stock. So this is 9 times the open interest changing hands today in Tesla at the 400 strike that expires today. You want to know what that looks like? Let's take a look. There are those 400 calls, and look, when the stock was 377 this morning, and that's during the show, folks. As we saw that, I'm in there buying calls. Why? Because there's huge volume in those calls. And the calls were under $1.90, or it's $190 a piece. A 10 lot would have set you back $1,900. Less than $2,000, you control 1,000 shares of Tesla. But, as the caveat always is with options, you have a limited amount of time to be right on that bet. And since these are the 4th of September calls, you had hours to be right. Not days, not weeks, not months, not years. Hours to be right. All right. Stock's trading under $378 a share. You see all of that on the screen. Well, where do you think it went over the next hour? To $30. I mean, come on, folks. Look at this. You're sitting there saying, wow, $27? How is that even possible? It is possible, folks. They crashed from the 27s into the $1.80, and then they headed right back up. And why did they do that? Because Tesla turned around. The low on the day was $372 a share. Right now, Tesla's trading at $419. It's been as high as $428. It opened at $402. $402 it opened, then crashed down, and then zoom to the upside, pushing these calls deep in the money. All right, let's get to some fresh meat. First of our 3 at 3, Apple. Again, I talked about Apple on the halftime report today, and I said, you know what? Apple, we're seeing huge put sellers in Apple, because there were huge put sellers at the 95 strike in October. Well, that's a bullish bet, because as I've already said, that's like an insurance company. You are becoming Warren Buffett when you sell a put. You are now that person that provides protection or insurance for whatever that asset is, whether it's a Mercedes-Benz or whether it's Apple. So if you do that at $95 a share, you could be forced to buy at $95 no matter how low Apple goes. It goes to $75. Those puts are $20 in the money. You'd have to buy stock at $95. And you only collected whatever the premium was for those puts. By the way, those puts were trading $2.35. Let's look at this trade, though, because as the halftime report was ending, we see January 135 calls trading from $7.50, let's say, to $9. $7.50 to $9, 20,000 times. That's 2 million share equivalent, my friends. 2 million share equivalent. So I had to follow these. January 135. Shoot, the stock was 135 this week. Pretty sure it traded let's see, Apple, sorry, AAPL, just checking my fills here. Yeah, Apple is up on the day. It's trading at $122 a share right now. So the recent high for Apple was 137.98. Bang. All right. So they started buying with the stock beneath 116 a share. Interesting. And they paid $765 for each one of these calls. Or they paid all the way up to $895 for each one of these calls with the stock at about 116. Where did the stock go? Well, there's just a little bit ago, the stock at 119.63. As I just told you, now it's 122. These calls that I bought and the stock that I bought and the puts that I sold are all making money today. Bang. So stock's back to 122 right now. As you see, it broke 112 today. And as it did, that's when I was aggressively selling puts, as I said on TV, live during the trading. And as I added to my Apple, which is still my largest position. Let's take a look at the second of our 3 at 3, shall we? Microsoft. What were they doing here? Same thing they were doing in Apple, folks. Some smart traders and gutsy traders who were willing to buy Microsoft at 185 provided protection at 185. So they provided that protection at $185 a share when the stock was trading $210 a share. Like I say, that's gutsy. That is what Warren Buffett does. That is where he makes his money. Because he sold Geico once, bought it right back. Because he said, man, there's no business like the insurance business. And he's right. So this is what the stock at 210, they were paid $4.70 for selling these puts, which are, again, protection. So if you got put the stock, it would be at 185 less the $4.70, which means effectively you'd be put stock at 180 and 30 cents when you take into account that premium. That doesn't seem like such a bad bet with the stock at 210. That's $30 that the stock could drop and you still make money. Now, where did the stock go? Well, it rallied to 211. Where is it now? 216 and about to go positive on the day. Bang! That's what I'm talking about, folks. That's why you want to follow options and trade them like I do. Let's do our third of our 3 at 3. Whoops. MarketRebellion.com/UOA. I guess that's it. I ran out of time. The guys pulled the plug. So, what did I do today? Jump back in Tesla after it sold off aggressively down to 377. It was 430. Just 3 days ago, it was $430 a share. Bought it at 385 today. Bang. And bought calls. Also, did Apple. Bought Apple calls, bought Apple stock, sold Apple puts. Very bullish trades. All of them working, by the way. Then I sold puts in Microsoft. I already own the stock. I've already written it with calls. And now I'm short puts as well in MSFT, Mr. Softy. Thank you, Satya Nadella. If you'd like to learn more about what we do, about unusual option activity, how we have these algorithms that show us where that big, fast money is right now, go to marketrebellion.com/UOA. I'd encourage you to do that, folks. You'll be a better investor if you have somebody who's guiding you through the process. Without giving you advice, we are showing you what we're doing during that trading day. We've got 5 of our analysts on that site basically talking back and forth with the other members of Market Rebellion. Thousands and thousands of folks that are following those unusual option activities. And if 20 trades or more a day is too much for you, we've got a 1 trade a day service. We've got a 1 trade a week service. And if you're really just an investor, maybe think about Pete's cash flow portfolio. Cash flow portfolio. That one is the one where Pete picks the favorite dividend stocks that show up on our screens and then overwrites those with big fat call options to take the returns to double digits. You want to learn more about it, go to marketrebellion.com. It's all there. Thank you, folks. I hope you have a great day, a fantastic Labor Day, and please stay safe and join us again back here. We've got a couple, by the way, podcasts coming your way this weekend because I was speaking with David Hightower of the Hightower Report. That podcast going up right now. And I spoke with Larry McDonald of Bear Traps Reports, and that is going up over the weekend as well. Make sure you check both out. These are two very smart men. And I got to get my friend Courtney Gibson on here because, Courtney, shout out to you. Courtney was buying Apple when I was buying Apple, and when I said it live on TV, Courtney pinged me on Twitter almost immediately and said, John, I'm buying too. I love that, Courtney. Love you. You're a classy lady, and you know what the heck you're doing when it comes to trading too. Bang. Thank you, guys. I hope you have a great day, and I'll see you soon back here on Market